Real pain is being inflicted upon the American people because 44 Democrats in the Senate have voted for the third time to reject the completely nonpartisan, completely clean, very simple 24-page continuing resolution that we passed in the House here 2 weeks ago.
Well, there it is. Trump admitted himself that he is using Americans as political pawns. Democrats do not want a shutdown.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Dominic Bunning, head of G10 FX Strategy in London, and today is Friday, the 3rd of October. The US government shutdown's moved into its third day, and you heard both sides of the debate there, first from Republican House Speaker Mike Johnson and then from Democrat Senate Minority Leader Chuck Schumer. As it stands, there's no real sign of progress, although that could always turn on a dime. For financial markets and economists in particular, the main near-term challenge is the lack of data to discuss and to guide us. Although the longer the shutdown rumbles on, the larger the potential negative economic consequences. We'll be discussing that with Jeremy Schwartz from our US economics team shortly. Markets, however, don't seem too concerned, with cross-asset volatility remaining very subdued, US equities breaking new ground higher, the dollar largely in the middle of its recent ranges, and rates markets also fairly steady. Away from the US, governments also in focus in Europe as we move firmly into budget season, putting fiscal policy at the top of the agenda, something that our economics team have published extensively on, and which we discuss with Josie Anderson in detail later. And finally, in Asia, it's all about central bank meetings, with the Philippines, Thailand and New Zealand all set for rate cuts in the week ahead, which we'll talk through with Chanam Bunoch, our Southeast Asia economist. So while the US government might be shut down, there's no rest for listeners of the Week Ahead podcast. So let's get stuck in. We're going to start in the US, and as we mentioned at the top of the podcast, the US government has gone into shutdown, but our US office very much not in shutdown. We've got Jeremy Schwartz from our US economics team joining us. Jeremy, you're clearly still working very hard with a paucity of data to really deal with. But look, how long is this shutdown going to last in your view? Is there a base case, or do we just have to sort of take it day by day?
Hey, Dom. Yeah, it's great to be back on the podcast. Shutdowns have tended to vary in length. For the most part, they've tended to be quite short in the past, but if you look at the past few, they've been trending to be a bit longer and longer, with actually the longest in history happening in Trump's first administration in 2018 to 19. So again, roughly a base case would be something like 1 to 2 weeks for how long this continues, but both sides do seem dug in, and there doesn't seem to be much progress in negotiations. So it will really be more about one side capitulating when there starts to be some pain from polling or from the economic impact of the shutdown. It doesn't really feel like there's working towards some mutually beneficial negotiation.
You mentioned that the economic impact, Jeremy. Is there anything that is going to really happen in terms of economic impact from the shutdown? I keep reading about layoffs being made and this sort of thing, but I think a lot of the previous data suggests that the impact could be small. How are you guys thinking about that?
Yeah, so typically in a shutdown, the impact tends to be very modest, something like 10 basis points of annualized GDP growth per week of the shutdown. That said, the longer it goes, the more chance it has of creating some economic drag. For starters, government workers who are on furlough don't receive their typical paychecks. And while they're due to get back pay, that can lead to some spending weakness, potentially some credit stress if it extends for a long time. And also, unlike in the past, the administration now seems to be looking to intensify the impact rather than mute it. Particularly, you mentioned this talk of laying off government workers. And while we still see that as more of a threat than a base case likelihood, it's something that, again, could potentially accelerate the economic impact on sentiment and on potentially consumer spending. In terms of the layoffs, typically federal workers are entitled to 60 days of notice before a reduction in force. So even if the administration went ahead with that, it wouldn't necessarily have any immediate impact on the labor data. But again, it can really intensify the impact on those workers who are furloughed and are already dealing with a little bit of cash flow stress.
Okay, thanks, Jeremy. I mean, in terms of analyzing or thinking about the economy in real time as well, we're obviously lacking a lot of the usual data sources we get from the government. We saw some quite weak ADP numbers in terms of jobs that came out on Wednesday this week. What are the key things we're going to be looking at from the private sector, and what is the latest data telling you on that front?
Yeah, so we're going to be without the usual tier one data, the employment report, CPI, and retail sales. But we still have a number of indicators, both from private sector sources, as you mentioned, but also the Federal Reserve is self-funding, so all of their data will come out as usual, as well as the state level initial jobless claims data. And actually that last one is what I would focus on most at the moment. Really, the labor market at the moment tends to be in this unusual balance where hiring has slowed but layoffs haven't picked up. That really makes layoff data the most important thing to keep track of as a potential sign of stress or a worsening deterioration. So claims, I would say, had risen in importance even before we were potentially missing out on NFP. That data is not going to come out at 8:30 on Thursday as it typically used to, but it should be released by the state organizations sometime on Friday, and we can cobble together the national numbers on that. You mentioned ADP earlier in the week. Again, that has functioned decently well as an indicator of the underlying trend for NFP growth, and it does suggest that there's some continued momentum slowdown. And we'll continue to get survey data from ISM, PMI, as well as the regional Federal Reserve banks. For the most part, I'd say our read on the latest data has been more of the same. There is this continued momentum slowdown in labor markets, but still no signs of stress. And for the meantime, we'll be watching closely for claims data, any signs of tightening in market-based credit conditions, or any signs that businesses might be pivoting towards more widespread layoffs.
Okay, thanks, Jeremy. So, kind of more of the same, as you say, the slowdown continues, but nothing too dramatic. And I guess we're still going to be looking pretty closely at the Fed at the end of the month where, a cut is currently expected. But I guess without too much data, it's hard for them to deviate from that path. Is that still a thinking briefly?
Yeah, I think so. And even going back to the September FOMC meeting before the shutdown happened, it seemed like they were setting themselves up with a very high threshold to not just go ahead and deliver this series of insurance cuts they've penciled in for year end. They marked up their inflation forecast for next year, marked up their growth forecast for this year. So once you're doing that and still saying you're going to cut anyway, even though you're expecting the data to be a little bit hawkish, then it's hard for the hawkish data to really stop you out of that decision.
Brilliant. Well, we look forward to that. Look forward to getting some more data soon, and hope to have you back on the podcast again in the near future as well. Thanks a lot.
Yeah, great to be back.
Well, moving on to Europe now, where there's no government shutdowns going on, but government policy is firmly in focus nonetheless. I'm joined by European economist Josie Anderson to talk about a new report that the team has put out on fiscal policy in the region. Josie, thanks very much for coming on. What are the key themes that you're drawing out from this deep dive into European fiscal policy that you've published?
Yeah, thanks for having me on, Dom. And yeah, we're quite excited by this report because we think as policy rates across Europe by central banks approach neutral or are at what we think is a terminal rate, we think focus is moving much more to fiscal issues. And these differ quite a lot across Europe. So obviously we had a big announcement earlier this year in Germany that it has this large fiscal bazooka, a spending package particularly focused on infrastructure and defense spending, which we think has the potential to boost growth quite a lot. But then we've got other countries like France and Spain, France and the UK, where the big theme has been challenges in meeting fiscal rules and improving debt sustainability, which governments have to balance with not damaging growth too much. And so we've got kind of countries with a lot of fiscal firepower and then countries that are really struggling to make it add up.
Yeah, I mean, you touched on the UK there. I mean, clearly one of the big focus points for markets over the next couple of months is going to be the UK budget situation. We're hearing quite a lot of press about, the size of the fiscal black hole and what Rachel Reeves might do. Is there any kind of easy way out here, or is it all going to be pretty challenging come the end of November budget, do you think?
Yeah, well, the challenges are that the OBR may well downgrade its productivity and growth forecasts, and then also spending cuts are very unpopular. We saw earlier in the summer that when the Prime Minister and the Chancellor attempted to cut welfare spending, it didn't really get through because MPs didn't like it, and they had to change the bill. And so then what you're left with is the option for tax rises to meet fiscal rules. But again, they can be very unpopular. And during the election campaign, Labour promised not to raise certain taxes, including VAT, income tax, and national insurance for employees. Now, people are talking about perhaps they might have to break that pledge even in order to raise taxes. But it's a tricky decision in terms of where they go to make things add up. And the Chancellor has committed to meeting her fiscal rules, so it seems like she will be doing that.
Yeah, I mean, that divergence, certainly in terms of the UK's much more challenging fiscal story and maybe Europe, where, yes, there are some challenges for some countries, but where in aggregate there's maybe a bit more space, a bit more capacity, is certainly one of the key factors driving our view of relative euro positivity on the currency space versus sterling. So, that's certainly going to be something we're going to be paying close attention to over the next couple of months. But turning just to the week ahead, not a huge amount of data from the continent particularly, but we do get some inflation numbers out of both Sweden and Norway. How are you thinking about those, and how do they potentially impact your views on central bank policy in both of those countries?
Yeah, thanks. So, I mean, starting with Sweden, where we also have fiscal developments there actually that will affect inflation, not this print coming up, but if we actually start bigger picture, the September budget was quite expansionary, so should increase economic activity, but actually will mechanically bring down inflation next year to close to 1% because of a food VAT cut that will, of course, bring down food prices. But actually looking at recent data, inflation has surprised the Riksbank to the upside quite a lot, mainly driven by things like package holiday prices and car rental prices. Those effects are unwinding, so we expect a slight slowdown in inflation. We're expecting CPIF inflation of 3.1% year on year in September. But then, yes, looking further ahead, it should slow quite significantly more looking into 2026. On Norway, we've actually seen fairly sticky inflation there. Energy base effects should actually cause inflation to accelerate a bit more in the September data. We expect actually 3.8% year-on-year inflation, but actually when you look at underlying inflation, when you strip out tax and energy effects, we expect it to remain at 3.1%. We do expect it to slow down over the coming months and into next year. But at the latest meeting, Norges Bank, did slow the projection for its rate cuts over the coming years. It actually said it only expects one per year, and the sticky inflation story does feed into its reasons for doing that.
Great. So maybe some modest policy divergence going on there for us FX strategists to think about as well in the Scandinavian region. So thanks, Josie. A lot to cover there, but I think we covered it all. Fiscal policy absolutely in focus, not just in the UK, but across Europe, and certainly some inflation to focus on just in the week ahead. Thanks a lot.
Thanks, Dom.
We're going to head to Asia now, where there's a bit of a holiday lull in the North Asia region, but plenty to discuss in Southeast Asia, especially on the central bank front. I'm joined by Chanan Bunach from our economics team in Singapore. We've got central bank decisions in the Philippines and Thailand. And Chanan, our view on the BSP appears to be slightly counter consensus. So why don't we start there? Can you explain to us what you're looking for from the BSP and why you think we could get a bit more easing?
Hi, Dom. Thanks for having me. It's a pleasure. We would say the view for the BSP cut is a bit out of consensus this time. Could be interesting as it could mark the fourth consecutive cut by the central bank. But we would highlight that inflation is still benign, and this will allow the BSP to provide some support for the domestic demand. One thing we want to flag is there's a concern about some water project, which we think could pose some downside risk to growth, the flood control projects. So we think the BSP can, still cut the policy rates with inflation not being an impediment. Yeah, but we would assign that the view for the cut is a close call, a 60% likelihood against 40% for the BSP to stay on hold in a more wait and see approach.
Okay, brilliant. And then in terms of Bank of Thailand, it seems like things are a little bit more consensus. Well, what's the view in terms of the rate decision, but also what's driving the Bank of Thailand in your view?
Yeah, there are plenty of reasons why the BOT should cut the rates. Growth is weak, deflation persists, financial conditions are tight. The interesting bit for the BOT this time is we will have the new BOT governor and one external MPC member joining the board. The two are widely viewed by the market as dovish. So all these factors should support the forecast for the BOT to cut this time. I think the debate now is whether the BOT can deliver a larger than 25 basis point. We think the chance is quite limited. There's still concerns by the BOT on the limited policy space. So because of this, we would assign only a small 5% chance for the 50 basis points, and then 65% for 25 basis point cut, and 30% for a wait and see pause after the cut at the previous meeting in August.
Great, well, very interesting, and certainly a lot of discussion points around those meetings, I guess. And notably, you wouldn't normally put the RBNZ and the BOT together, but we're expecting a kind of similar outcome from the RBNZ, where there is this risk of a 50 basis point cut potentially, but we think they'll only cut 25 basis points. That's the other big central bank decision happening in the Asia Pacific region next week on Wednesday. So there is this risk of a 50 basis point cut from the RBNZ, but we're pretty skeptical that they'll deliver that. We think they'll cut this week, they'll cut once more later this year. And we do think, some of the negative GDP news recently was driven more by temporary factors in terms of inventories and export growth. And we also note that the RBNZ's chief economist mentioned that the worst seems to be behind us in the last meeting's press conference. So with some of the survey data turning a little bit more positive, we actually think this could be an interesting catalyst for the market to maybe turn a bit more positive on the New Zealand dollar as well. So there you have it for Asia. Lots of central banks, 3 central banks, BSP, we're slightly counter consensus, Bank of Thailand a bit closer to the centre ground there, and RBNZ, we expect a 25 basis point cut. Thanks very much, Sean, and great to have you on.
Thanks, Dom. Pleasure.
That's all for this week. Thank you, as always, for joining us for the Week Ahead podcast, which was edited and produced by John Dalton. We'd love to hear your feedback, so please do feel free to leave a comment and subscribe to Nomura's podcast on Apple, SoundCloud, Spotify, or your usual podcast provider, and share today's episode with anyone you think is interested in the latest macro and market developments. You can also check out nomuraconnects.com for more of our research and updates. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.